A warm welcome to both of you. So let me take the LP view first. Satyajit, HDFC has been investing for over 2 decades in the alternative space. Give us an overview of how HDFC's views on the alternative investment fund market has changed over the years, and how comfortable or wary are you of investing in this asset class today?
Joe, I think I would like to start off by saying that, we started off investing probably in the late 90s. So as an investor, we probably are among the earliest of investors into the alternative space. And we have taken both LP positions, as well as we have helped taken GP positions in couple of funds as well. So we have had a fair degree of experience. Now, we continue to invest, but we invest very selectively. And why is that? I think the critical issue that how do we continue to see this space? One is that we haven't really seen that the space has matured to the extent that it might have. And what do I mean by that? What we find still is that exits, for any investor in a fund, ultimately it is when I get my money back along with a certain amount of return. That is what really makes a difference. And I think for us, at least, I can't speak on behalf of other LPs, but at least our experience has been that barring a few funds, exits have always been difficult. And I think part of the reason, and I think the overall strategy, I think it's about some funds not being very focused on sectors. So there's a sort of a scattergun approach, subpar stakes in companies. So all of this put together has meant that, the ability to drive an exit. Every promoter comes in and wants an exit via an IPO, but that's not always possible. So I think that is what has really left us a little wary still. So we like to see funds where there is a proven track record of exits.
Okay. Which means you are wary still, and we'll talk a little bit more about exits a little later. We'll dive deeper into it. Now, coming to you, Gopal, tell us about the Indian private equity fund managers' experience about raising funds from domestic institutional investors specifically over the years. What are the challenges that GPs like you still face while approaching domestic institutional LPs?
Well, start with the caveat that, over the last 15 years, 90-95% of our capital has come from global. And Indian private equity has come a long way in 20s. I think private equity arrived prematurely in India as an asset class. Private equity principally works in large economies. And it is only now in the last, I would say, 2 or 3 years that there is evidence that private equity has started to work in India. So if you see the global private equity industry, $1.4 trillion, 90 to 95% of the performance comes from large and sophisticated economies. And India, until recently, was neither large nor sophisticated. Even though many people have to see India in their own minds, India is a large economy, not by global standards. And it certainly is not a sophisticated economy. Private equity is a highly sophisticated product that requires a sophisticated ecosystem, markets, entrepreneurs, a control orientation, presence of debt, so many things. So as India comes closer to becoming a $3 trillion economy, there is some evidence that private equity is starting to work in India. The question then is that how come over the last 20 years, a certain set of global investors have invested in India, even though, as Satyajit has rightly said, private equity as an asset class hasn't delivered great returns. And the returns are unduly concentrated in a few managers. So first of all, the asset class hasn't delivered great returns. then whatever returns you have is unduly concentrated or unhealthily concentrated in a few managers. What has driven global investors to India so far is diversification. So diversification is what has driven global investors to India. Now let's come to India itself. I'll start with my conclusion, and this is something that we've been working on at IVCA and in various forums with the government. Now that private equity has started to work in India, now that interest rates in India are seeing a certain compression and various other factors, the only way that you will bridge the gulf between institutional appetite and private equity as an asset class is to set up an ecosystem of fund of funds.
Mm-hmm.
We have a start, NIF is doing a sterling job, and there is the SIDBI fund of funds, but we need 10 more. So you will see a dramatic scale up in the amount of capital invested by institutional investors in Indian private equity when you see this ecosystem take place, which is a critical number of fund of funds. HDFC is an exception to all of this. HDFC is an exception to India. There is India and there is HDFC, right? Mm-hmm. Most people, when they buy HDFC, people think they are buying it, but they are really buying HDFC. See, very few institutional investors, and the size of Bunji don't need fund of funds. HDFC has been a setup. And this is not to sing paeans to them. What I'm saying is there will be exceptions to what I have recommended. There'll be some managers for whom fund of funds may not be appropriate.
Cool. The idea of, creating 10 more fund of funds over the next 10 years is, something that sounds very dynamic. Coming to Satyajit now, one of the main complaints of the GPs has been that domestic institutional investors are impatient and don't have a long-term horizon. Do you think there's a way to find a solution to this?
I think it is actually a question of the sophistication of the market development of the market, as Gopal very correctly pointed out. The issue really is that, when you talk about, it is always an asset liability mismatch for all of us, right? Whether you are an AIF manager or you are an investor into an AIF. And when I'm saying AIF, I mean all alternate schemes, funds. Now, if the bulk of the funds that are available to me are long-term in nature, mm-hmm. then I have the luxury, the flexibility, or actually even the necessity to look for long-term assets. Mm-hmm. Unfortunately, now where does that long-term money really come from? Typically, that long-term money comes from pension funds and insurance companies. As Sujoy in the earlier talk, Sujoy was talking about, EPFO is becoming one of the largest pension managers in the world. Mm-hmm. Now, the question is that it is ultimately, until we start seeing the pension funds and the insurance companies, who all have their own constraints, both regulatory and otherwise, until we see that changing, it's going to be very difficult for Indian institutional investors to take that 8, 10, 12-year view on any investment that they make. And thereby they start, today, if most of my liabilities are, let's say, if I have a duration of, let's say, 7% or 7 years or something like that, or 5 years, mm-hmm. then obviously then I'm going to also sort of when I'm going to do on the other side, when I have assets, I would like to keep my duration on my assets also close to 7, and 7 is an exception. In most cases, the duration would probably be in the range of 3 or 4. Mm-hmm. So that typically is what drives this impatience.
Coming to you, Gopal, There has been this trend of private equity firms making investments in new age digital and SaaS companies. For instance, Gaja Capital late last year invested in a SaaS firm, Lead Squared. I wanted your views on whether LPs will change the way it looks at Indian private equity firms that are adding technology as one of its focus areas.
Technology investing in India has come a long way over the 7 or 8 years. And a point of inflection was 2015 when Geo happened. Inflection was COVID. Thanks to this, technology in India has now become a growth stage opportunity. The reason why firm Gaja Capital has invested in technology is not because my predecessor firm was the View Group. We were one of the pioneering firms in technology investing in India back in 1998. We have very strong background in technology and understanding. We were waiting for technology to mature from a risk perspective. When we would look at companies, they would essentially betray a venture capital like risk. Unit economics negative, very high burn rates, so on and so forth. Like I said, this is a venture capital profile. What has happened thanks to Geo in 2015 and COVID in 2020 is that India Tech 2021 now has a set of opportunities which map to growth stage risk. Gaja Capital has invested. You will also see other growth investors start investing, private equity investors start investing in technology. So we, based on what is attractive for fundraising, we invest based on what meets our criteria. Not a certain risk. We are not buying venture capital risk. We are buying a certain risk. For us, what we have demonstrated over the last 15 years is that we basically, on the downside, behave like a AAA debt security. At a fund level, the chances of an investor losing capital are very low because you could never say zero, even the track record which says that. On the downside, we behave like a AAA security. On the side, we have a certain return. In order to deliver this, we cannot buy venture capital risk. We buy growth capital risk. Unit economics positive, a certain scale. Express Bs, Lead Squared, these are all examples of growth stage risk, which is a certain scale, a certain unit economics positivity. And now what I'm saying is that in many sectors in India, e-commerce is one, SaaS is one, you're starting to see a critical size of growth stage opportunity. And therefore, technology, given our backgrounds, we have sought background in technology. We've been pioneering investors in technology. We were waiting for India to mature. And therefore, it will be in our Lead Square is the first investment from our fourth fund. And therefore, Fund 4 will see more investments in technology for the reasons I mentioned, which is technology in India has become a growth stage opportunity.
Cool. Satrajit, how do you see LPs like you look at this adoption of technology as a theme by private equity firms today?
I think technology is the way forward. All of us, both as consumers, as consumers, I think we're all going towards adopting more and more technology. Our lives are being driven more and more by technology. So yes, obviously, this is going to be an area where people are going to be investing, and it's very good that it's happening. The only question that I have is that there are very few people who seem to understand what they're doing. Okay. And I hope that everybody who does this is people who are investing. As long as people understand the technology that they're investing in, I think it's all good. If they don't, then we have a problem. And I think more than the technology, what they need to understand is that do they understand the use cases? Because, it may sound wonderful. Technologically, it may be fantastic, but the use case may be whatever, fairly average. So I think people need to understand the technology and people need to understand the use cases. So it's not going to change really. It really doesn't change. It is that, does the fund manager know what he's doing? If that be the case, happy to invest.
So, we'll come to exits now. We'll start with you, Gopal. So exits have been tough for the entire industry, and both of you have mentioned, in the opening remarks only on how exits have been difficult. But do you see the overall exit environment improving in India now that will help the alternatives of the class to, say, attract more domestic and LPs on board?
If you see the data, then there is clear evidence that the industry's exit track record, exit intensity is increasing. So India, while yes, 15 years ago we were a 2 billion a year market, and today we are a 40 billion a year market. People think we've gone from 2 to 40. The real story is on exits. We've gone from literally nothing to a very large number. Why is this happening? I'll go back to my point. Private equity arrived prematurely in India. It's only now that the market is assuming a certain critical size and a certain sophistication. Secondly, see, the workhorse of the private equity industry is not the IPO market. It is the M&A market. One of the big stories in India in the last decade has been the catch-up of the M&A market to the size of the Indian economy. If you go back to 2010, we had an extremely disproportionately small M&A industry. Get to 2020, there's been a dramatic scale-up in the size of the M&A industry. So this is what is behind the improvement in the exit data. And I do believe this trend will go and strengthen further, which is that the M&A market, which is the workhorse, IPOs are the show horse, M&A is the workhorse. Globally, 2/3 of exits happen through M&A. And M&A was missing in action. Prior to 2008, when we were investing as Gaja Capital, we were investing with IPOs in mind. And thanks to 2008, the public markets went away. Investors lost their shirt, if you remember, in 2008 public markets. And an entire generation of investors never came back to public markets. So our fund too was invested with M&A markets in mind, which is why we have the exit data that we have delivered to our investors. If we had relied on IPOs, we wouldn't be anywhere. And yes, we currently again have IPO markets alive, and they're catching the attention of all investors, the Robin Hood phenomenon. But IPO markets are inherently volatile. Private equity is a long-term asset class. It cannot depend on IPO markets. M&A markets really define the quality and the consistency of exits, which is mercifully happening. There is another aspect which is related to sophistication. And I'm going to sound like a broken record here because I'm going to end on fund of funds. But please understand that another aspect of sophistication is secondaries. So what is starting to happen in India is the market for secondaries is emerging. So globally, private equity managers are notorious for not completing their funds in the designated time period. So if you have a 10-year fund, you rarely get 100% disposal in 10 years. Then what happens? Secondaries take over. That is starting to happen.
Coming to you, Satyajit, exits have always been a thorny issue for LPs in general. What has been the general experience of HDFC in terms of returns generated from this an asset class? And within this asset class, where have you derived the maximum returns in a firm? Because you've, spread your bets across some of the alternatives in asset class.
I don't want to get into numbers, and I certainly don't want to get into specific firms or funds.
Right.
Suffice it to say that, as Gopal alluded earlier, if public markets have delivered, let's say, between 12 and 13% CAGR return, I think it was reasonable to expect that private equity alternate funds would generate a certain return, which would at least a certain delta over that. At least our experience has been that, barring a few funds, most have not come close to that. Very honestly speaking, one of the challenges that we've seen with return generation has been that, how do I put it? It's basically that people have taken on a venture capital risk while targeting a private equity return. That typically never works out.